Hello everyone, I'm back from my overseas trip and I hope everyone is coping okay with the current market. In this video, I will provide an update on my view of the stock market as we enter the new month, June, which could be a crucial month. I will also provide some simple technical analysis for the various mega cap stocks and share my view on a few investment strategies, so stay on to find out more. But before that, if you like such videos, I hope you can help me with the like and subscribe buttons. Your small action means a lot to me and the YouTube algorithm. Looking at the S&P 500, the market bounced and rallied from around 3008 to 3009 range towards the end of May. It is currently sitting comfortably above 4000 for the last 1 week. To highlight, on Friday, 3rd of June, the market once again showed weaknesses as Syfe, which tracks the S&P 500, was down by 1.6%. QQQ, which tracks most of the tech stocks, was down by 2.6%. And we have Apple falling by close to 4%, and the big loser of the week was Tesla, losing a whopping 9.22%. Personally, I feel we are not out of the woods yet, especially when the Fed has started their quantitative tightening cycle this month. For viewers who are not aware, quantitative tightening, in a nutshell, is basically a way to reduce the money supply floating around in the economy. With the QT, I would expect high volatility to continue, so do expect similar big percentage movements in the weeks and months ahead. The reason for this is what I have always been sharing. When the Fed and market makers take cash out of the market, there will be lesser liquidity, which will cause stocks to move up and down quite aggressively. It's like you can have 4 to 5% upside today, but come tomorrow, the gains can be wiped out by midday, so don't be spooked out by this. Together with other headwinds such as interest hike, the ongoing war, etc., I think there is a high probability that we are going to retest or even break the recent lows again. Anyway, a quick disclaimer, this is only my personal view and not financial advice, alright? Let us move on to the technical analysis segment. First up, let's talk about Death Cross. In case you are not aware, Death Cross is a chart pattern that indicates weakness in the stock price, and it is usually termed as 50 moving average crosses below the 200 moving average. We have seen several Death Crosses since the start of the year. It's like Death Cross everywhere. And it is even more concerning when they appear on various mega cap stocks. For Microsoft, Death Cross happened on 15 March and the stock closed at $286. Its current stock price is $270. For Google, Death Cross appeared on 9 March where it closed at $2668 and the stock is currently sitting right below $2,300. Next, Nvidia. Death Cross happened at around 20th April where the stock closed at $214, and look at where the current price is, below $190. Very recently, we have Death Crosses appearing on Apple and Tesla too, which I have posted on Momo. For Tesla, it appeared on 26 May and the stock closed at $707. The current stock price is just around $703. For Apple, it appeared on Friday 3rd June and the stock closed at $145. To also highlight, the last time Apple had a Death Cross was back in December 2018. So, does it mean there's more downside for both stocks? Is Tesla going to revisit $600 range? Is Apple gonna hit sub 140s or 130s range again? I can't be sure. However, given the current weak market sentiment, I would say the probability is quite high. But once again, this is not financial advice, so if you want to short the stocks or buy puts, please do your own duty. Anyway, I also want to highlight that Death Cross is a lagging indicator, so do put a limited amount of reliance on this pattern. But that being said, I feel it does say something about the overall market trend when so many mega cap stocks had Death Crosses appearing on their chart. I mean, those examples that I've shown earlier are some of the top 10 companies in US. Next, a quick look at VIX. In case you are new to this, a higher level of VIX means there is more risk perception or fear in the market, and vice versa. Therefore, if VIX is low, the fear is low, and the market will likely go up. So in my previous video, I shared that the support level for VIX is around $25. In other words, if it bounces off the support and goes up, the overall market will go down. And of course, if the support level of 25 breaks and VIX falls below that, the rally could continue. As it stands, VIX is just right below 25, which acts as a resistance now. Hence, for next week, keep a lookout for VIX. If it goes above 25 and stays there, I would think the rally has been cut short and the market is heading down. Now let's take a look at SPY. It broke out of the steep downward channel during the recent rally, but don't be too excited yet. For it to be bullish, I am looking at two levels that it needs to reclaim, namely 415 and 424. In other words, it needs to break and stay above these two levels to show some sign of a bullish trend. And for the breakout to happen, I'm looking at 61.8 Fibonacci retracement level, which is around 430. On the other hand, if it breaks below $400, I would think the rally has been cut short and it will be on its way to test the recent low of 380. For Apple, similarly, it has broken out of the downward channel during the recent bounce up. But once again, don't be too excited, because when you take a look at the weekly chart, it failed to reclaim the long-term uptrend marked by the green line. It also didn't retest the 50 moving average level. Both levels are 154 and 156 respectively. In short, anything below these two levels, the trend is still bearish. Going back to the daily chart, the support levels below the current price are 140, 137 and around 135, where the lower band of the Bollinger Band is. Specifically, I see 140 as a key support level as it coincides with the downward trend line. So if the stock breaks below this level, it's breaking the first support level and also breaking back into the downward channel. From there, I think 137, 135 can be hit quite easily. Next, the retail investors' favorite Tesla. The stock was down quite a fair bit on Friday after Elon Musk shared that they are going to cut 10% of the staff, and also he feels super bad about the economy. A look at the stock chart shows that it is still in a bearish trend. It tested the top of the downward channel, got rejected, and went back to the channel. It is very tough to predict how the stock will move in the next 1 to 2 weeks, so let's take a look at both the up and downside. If the current rally continues, then we can expect Tesla to retest the upper channel again. And coincidentally, that is roughly where the first Fibonacci level sits, at around 746. But given Tesla's high level of volatility, going above 746 shouldn't excite investors. We can be slightly more excited if it goes above 800 and 823. On the flip side, if the market wants to go down, there are very little support below $700, where it is dangerously sitting at right now. A test of the recent low of 620 is very possible if the market sentiment is weak. And to highlight, that's where the lower band of Bollinger Band is as well, around 625. Personally, I think this is a good price point to load up a share or two. For Microsoft, if you have followed my past videos, you will know that sub 270s is a strong support, which coincidentally, the stock is currently sitting at this level right now. In my view, I think the stock needs to go above 280 to be bullish. On the downside, there is this little gap that may act like a magnet and suck the stock to its level, which is around 244 to 245. For investors who are keen to accumulate some Microsoft stocks, personally I think you can get a few at this level. Otherwise, the next good buying opportunity would be sub 200 to 220, which we don't know if it will ever get there. It all depends on how much the market wants to crash, if it's crashing. Next, we have Nvidia. The stock actually moved per the bear flag which I have drawn. For info, I didn't amend what I drew, and surprisingly, it bounced off exactly where my arrowhead is. Anyway, it's currently at the upper band of the Bollinger Band, and it is very likely that it will get rejected and hit down to test 178 support level. And if the broader market is weak, the recent low of 155 could be tested, as well as the support level below it at around 150. Alright, now let's discuss a bit on investment strategies. For the last 2 years, it seems like the most common investment strategy was to buy the dips as the market was on the bull run. So whenever there was a little dip here and there, investors will enter and then ride the next wave up. But this year, it appears that this is a sell the rip season. In other words, the strategy is opposite now, where investors take profit whenever there's a little rally here and there, before the market continues its way down. Other investment strategies that investors are doing now or can consider doing in this bearish market is to buy puts to hedge their portfolio or sell covered calls, as both are bearish moves. But the prerequisite for selling covered calls is you will need 100 shares of a particular stock. Otherwise, you can also still sell puts. Though it's a bullish move, one can choose a lower strike price. But for this strategy, it is recommended to do on stocks that you really don't mind owning 100 shares of it. For example, I did it for Apple and pocketed some premiums. The contract that you see on the left has expired, while the one on the right is expiring in the coming week. As long as Apple doesn't fall to 130 or below, the premium will be mine to keep. Personally, I think Apple at 130 is really a good price, hence that explains my strike price. But as the market continues to go down, I may shift the strike price to 120. This brings me to the next point. Be nimble in this market. Watch how the market moves and moves along with it. You don't want to fight the trend, be it upward or downward. Anyway, let me know if any one of you wants to see videos on options from me. For investors who are not familiar with options, it is okay. I have done a video on what you can do during a crash. And if you are a buy and hold investor, can also check out my other video on good entry prices where I classified them into two segments, blood in the street segment and coming out of retirement segment. At the end of the day, your investment strategy depends on your personal financial goal, risk tolerance and the amount of hard work you put in. I mean, all roads lead to Rome. Choose one that suits you. And I think we all shouldn't criticize other investors' strategies such as buy and hold, take profits, hold cash, day trade, etc. The market has enough of negativity, so I think we all should focus more on positive aspect of things. Alright, that's all for this video. If you have found some value in this video, I really hope you can hit the like and subscribe buttons. They mean a lot to me and will keep me going. Thank you.